Good morning, everyone. Thank you so much for joining us today for our virtual client event. My name is Matt Evans, and I'm the President and CEO of CWB Wealth Management. I'm excited to be with all of you today virtually, and I'm of course excited for the day we can all do this together again in person. We trust that day is not too far away. In the meantime, we remain focused to create engaging virtual experiences like this one. We hope you enjoy the discussion this morning as we aim to provide timely and useful insights to help you untangle the forces driving financial markets around the world. And timely is a meaningful word in that statement, as we are currently experiencing a volatile period in the economy and in financial markets. These are the moments where conversations like this one, like the one we'll have today, can be extremely meaningful. Before we begin, I'd like to start the meeting with a land acknowledgement. I'm joining you today from the place currently known as Edmonton and historically called Beaver Hills House or Amosquachee-Waskahikan within Treaty 6 territory. This is an historical gathering place of many First Nations and is part of the Métis homeland. We acknowledge that the group of us today is coming together from across the many nations, treaty land, settlements, and unceded territories of what is currently known as Canada, and we recognize that we are all treaty people. We each have the responsibility to uphold the nation-to-nation agreements from which Canada grew and to continue to renew our relationships and move toward meaningful reconciliation. Here is where we begin, and we'll walk forward with open hearts and good intentions. I'm going to introduce today's presenters in just a moment, but first I'd like to say a few words about our firm. CWB Wealth Management, headquartered in Edmonton with offices in Vancouver, Edmonton, Calgary, Toronto, and Montreal, is a proud member of CWB Financial Group. Our legacy of private wealth advisory services goes back to 1939 to the founding of Leon Fraser and Associates. Across our brands, we now manage more than $8 billion of private wealth assets on behalf of our valued clients, with another $2 billion of assets under advisement within our TE Wealth Indigenous Services channel. Through our staff of 200 professionals and 40 private wealth advisory teams, we're proud to provide professional investment management with exclusive access to proprietary strategies and third-party solutions, alongside sophisticated financial, tax, and estate planning, asset protection strategies, and risk management. This morning, I'm very pleased to welcome our clients to this event. This is our first virtual client event of 2022, following on from the event we held last November. The clients of CWB Wealth Management, CWB McLean & Partners, TE Wealth, including Doherty and Bryant, and TE Wealth Indigenous Services, and Leon Fraser and Associates, it is truly a privilege to join you here this morning. We're grateful for the trust you have in us and grateful for the time you've chosen to share. I'm also pleased to welcome clients of CWB and colleagues from across the CWB Financial Group. Finally, I'm pleased to welcome anyone who has joined us today out of interest and who may not yet have a relationship with CWB. Glad to have you, and we hope you all enjoy the event. With that, I'm going to introduce the folks you'll hear from today. Moving to the next page, Scott Blair will moderate our panel discussion. Scott will be joined by several portfolio managers representing Scott's very strong team with experienced talent covering Canadian, US, and international equities, as well as sovereign debt, investment-grade corporate bonds, and other credit products on the fixed income side. Today, you'll hear from Gil Lamott, Malcolm Jones, Rick Palombi, Liliana Svetkova. Saket Mudra is unfortunately sick this morning. I'm going to, with that, turn it over to Scott Blair. Scott, you can take it away.
Thanks, Matt, and thanks everybody for joining us here today. As Matt mentioned, my name is Scott Blair. I'm the Chief Investment Officer here at CWB Wealth Management, and it's a real pleasure to be here. We did a presentation last November called Conquering the Wall of Worry, and in that presentation, I spoke for about half an hour about the economic and market environment that we were in. This morning, we're going to do something a little bit different. I'm going to be the moderator, as Matt had said, and I'm going to discuss or really bring in the panel of experts that we have here this morning to answer a bunch of questions. And the questions are really around three key themes that we have identified from our conversation with clients and from questions that were asked previous to this presentation. So our plan is to leave about 20 minutes at the end for Q&A, and when we do that, I'm going to be monitoring the questions that come in through this presentation, and I'll ask those questions of our panel on the Q&A. So before we get to the team, I just want to set the table a little bit about what's been happening in the markets. To say it's been a crazy couple of years is really a massive understatement. I think we all agree this pandemic period has been something we've never seen before. This chart shows major market returns from the start of 2020 to the end of 2022. So as you can see, well, actually, let me take a step back. The way to read this chart is if you invested $100 in the market at the start of 2020, what would it have been worth 2 years later? And as you can see, the pandemic has actually been an incredibly strong period for asset returns. So the gray line or gold line, the top line on your chart there, that is the US equity index. So $100 invested in 2020 would have been worth almost $150 2 years later. Similarly, the dark blue line there is Canada. You would have made $32 with 100 invested 2 years back. So if we look at international equities, the light blue line, it's also done well, and bonds positive territory also. So, you know, everything was solidly up despite having a massive downtick in March of 2020. We saw $100 turn into $70 in the matter of just a couple of weeks through at the peak of the pandemic fear. But the markets recovered very nicely going into the end of the year, the end of that 2-year period. So if we go and think about this year, one of our takeaways from our presentation last year was that the market always climbs a wall of worry and that things can change quickly in these uncertain times. And, you know, boy, has that absolutely been true. As the calendar turned to 2022, volatility increased, fear started to increase, and we saw the markets almost immediately start to go down. So this is the same type of chart as the last one. $100 invested at the start of this year would have been worth, you know, just a couple of bucks less if you invested in the Canadian market. It's held in very well. But in US, international equities, or even Canadian bonds, you're down double digits. So a very difficult start to this year. And that brings us to our first theme or adversity, which is really today's economic environment and how rapidly it's changed. My first question is going to be for Malcolm Jones. Malcolm's based out of Edmonton, and as Matt said, he is our head of fixed income. Malcolm, at the start of this year, we were in a relatively positive mood. We acknowledged there was a lot to be worried about, but the belief was that inflation would start to moderate, supply chains would moderate as we started into the year, the pandemic subsided. Really, what has happened since the start of the year?
Thanks, Scott. I'm happy to take this. I think the big difference that we're seeing from November is the expectations in inflation. Now, let me take a step back here and say during the pandemic, we had a lot of government and central bank stimulus. We saw a lot of COVID-induced supply chain issues, and all of that adds up to inflationary pressure. So let's have a look at this chart. When we're looking at the navy lines, these are the expectations for the average of 2022, and the gold line is expectations for 2023. Look at the left-hand inflation chart, and particularly at the blue line at November of 21. You can see at November of 21, the expectation for inflation for 2022 was approximately 3%. Now, here we are in May. We've seen the stimulus start to be withdrawn. You've seen some of the supply chains start to recover, but expectations are now showing that inflation will average roughly 5% over 2022, not returning to that 3% level until 2023. What's the big change? And the big change is, of course, Russia's invasion of Ukraine. This has placed further constraints on supply chains, as well as damaging commodity flows. Now, the potential good news that we have on this inflation front, inflation is still expected to fall over the course of the year, maybe not as quickly as we were expecting as we in January. And in fact, there is certainly a lot of consensus that we're actually past the peak of inflation. The most recent number that we saw did actually see a very slight downtick in the inflation number. The other thing to pay attention to is, what does this mean for growth? And what the markets are suggesting, while inflation is going to be a significant issue, what is going to happen on the growth side is we're going to see a redistribution of who are the winners and who are the losers. But the overall GDP shouldn't be affected that severely. Have a look on the right-hand chart. Here we were seeing GDP expectations in November of, call it 4%. And now here we are in May with maybe a slight downtick to that GDP figure, but still a very respectable number. And certainly we're not seeing a recession in the cards, or the markets are not expecting a recession to be coming over the next 2 years.
Thanks, Malcolm. Let's turn now to Gil. Gil is our head of Canadian equities, and he's based out of Toronto. So Gil, you know, we have the Russian invasion of Ukraine. We won't get into the the tragic human cost there. We're going to focus on the investment and the economic outlook. So what about the commodity prices? On the chart Matt showed you on the chart Malcolm showed, we really saw commodity prices spike up when Russia invaded. So why don't you walk us through what's going on with commodities, and can we expect any relief anytime soon?
Thanks very much, Scott. Well, as you mentioned, let's take a look at some of the commodities that have been driving the inflation that Malcolm was speaking to. The cost of oil, fertilizer, and wheat work their way through to the consumer in the forms of transportation and food. So this chart shows what $100 worth of each of these in early 2020 would be worth today. You can clearly see an inflationary trend there. Now, we've seen oil prices strengthen consistently since bottoming out early in the pandemic. And one of the key drivers here is the lack of new production. At $100 per barrel of oil, the companies are producing at maximum capacity. Increasing production, therefore, will require capital investment in new projects, and that is not taking place at the moment. So until we see significant investment in new production or some sort of material demand destruction response, it isn't difficult to imagine $100 oil being somewhat persistent. Now, fertilizers are a commodity that may not catch our attention day to day, but they directly affect the cost of producing food. And with the war-related sanctions on Russia and Belarus, both very significant fertilizer producers, global supplies have been reduced, leading to a spike in prices. And this supply shock is a direct result of the war in Ukraine, and therefore its duration is very difficult to determine. Now, tied to this is the price of wheat as well as corn. Ukraine grows and exports both of those grains, and it is unlikely that they will have a crop this year or even next. This is another war-related supply shock, but one that would likely take time to recover from, even if hostilities should end, given the amount of damage done to all manner of infrastructure in that country. Scott, these higher commodity prices have been feeding directly into the higher inflation that we've been seeing. But bear in mind that it is the increase in these prices that drives inflation. If these and other commodities remain at high levels but stop increasing, then inflation would actually moderate.
Yeah, thanks, Gil. It's very difficult to remember at this time that we actually couldn't give a barrel of oil away 2 years ago, and then here we are now. So let's turn it over to Malcolm. We talked about inflation expectations and how they've changed. We talked about commodity prices, how they've run up. What the central banks have one main tool or a main tool that they use to combat inflation, and that's interest rate increases. Maybe walk us through how those expectations have changed and what the central banks are saying now.
When we were going into the beginning of the year, even through the middle of last year, the central banks had been telegraphing that, yes, they want to provide stimulus to the economy while we're in this pandemic. As we start to emerge from the pandemic, they want to start to take that stimulus away. They want to return bank rates to normal, and I'm saying normal in quotes because it's usually defined after the fact. Have a look at this chart. The teal line here shows the history of bank rates, Canadian bank rates, going back to 95. And I want to concentrate on this navy bar here on the right-hand side. As we were going into the beginning of this year, expectations were that the bank rates would be increased about 100 points or 1%. And as you can see from this navy bar, that puts us back, give or take, where we were just before the whole pandemic broke open. Now that we're seeing this additional pressure from inflation, you're seeing a revised market forecast up to the gold bar. Currently, market expectations are for the bank rate to increase even up to 300 points or 3% from where it was at the trough. And this puts us back to a position roughly where we were before the financial crisis, the big financial crisis of 07-08. So we have the banks returning interest rates to normal and fighting inflation, and we would expect that 3% target is a reasonable target going forward, because we're going back to where we were before all these situations showed up.
Thanks, Malcolm. And just to summarize this first theme, although inflation may be peaking, our panel says it will likely take longer than we previously expected for inflation to come off. The war in Ukraine has really magnified existing issues that are out there with regards to inflation, and have really taken the rate expectations for rate increases up significantly. And rates are, as this chart shows, expected to reach levels we haven't seen in over a decade. So given this backdrop, by far the biggest question we receive from clients is, what do I do with my money? What do I do with my investments? How do I protect my portfolio from inflation? So we're going to take a significant amount, a pretty big chunk of our time here to talk about that and walk through each asset class. So this is a good point to bring in Rick Palumbi. Rick does double duty for us. He is the head of our international equity team, as well as running a diversified income fund for us. Rick, it's been a pretty brutal time for traditional bonds so far this year. What can investors do to protect against inflation in this space?
Yeah, thank you, Scott, and welcome everyone. It has been a brutal time. Clearly we've seen the impact of what's gone on in the inflation market and the rates market, and there's been no place to hide. Equities down, bonds down. So it's a difficult time for clients, and we recognize that. But we also know that in this time is where the money is made, and this is how to take advantage of the situation. So when we take a step back a little bit, obviously higher inflation is the nemesis for bonds. Most of them obviously have a fixed coupon, so higher inflation really erodes purchasing power. And on top of that, the way that central banks fight inflation is by raising interest rates, and taking interest rates higher means that bond prices go down. So it's a double whammy really for fixed income in this environment. That's why we're seeing the markets go down by double digits, because your purchasing power is eroded, and then as interest rates go up, the capital is also eroded. So it is a difficult time. But what we're looking at here is the allocation of how the diversified fixed income, DFI, as we call it internally, is structured. And what we try and do is try and protect from inflation over the longer term. In the short term, nothing works because everyone is fearful and panic and they're selling. So nothing is immune from rising interest rates and rising credit spreads. But being disciplined and taking advantage of that will actually lead to better performance down the road. So, for example, floating rate bonds, which are a fairly significant portion of the diversified fixed income, actually protect because the premise is that as interest rates go up, floating rate bonds reset every quarter at higher and higher coupons. So you're protected and you're shielded from the inflation. It doesn't mean though that you're going to get a positive return after capital. But what it means is that your income stream is going to grow. Similarly, with different types of capital structures, whether it's hybrid bonds or subordinated debt, those bonds also do well in an inflationary environment where interest rates are trending higher. So all of that is in the portfolio, but it's not for the short term. Nothing has worked in the short term, but we have positioned the portfolio for better performance and better protection down the road. So when we look at the left-hand side of the chart, we see that in December 2021, the current yield of DFI, diversified fixed income, is 4.45%. If you bought it on that day. Fast forward to April, the current yield after taking advantage of the situations and what we see in the market is now 5.75. So we've upgraded the yield. We've kind of set the portfolio up, and we're getting paid to wait. So a 5.75% current yield while we wait for better opportunities to make capital appreciation is how we're looking at the fixed income market today.
Thanks, Rick. Yeah, an important point that when the market moves really rapidly, there's often nowhere to hide. We saw that in March 2020, and we're seeing it again, really. So, Gail, let's go back to you. Historically, people have thought of equities as a great place to protect capital and at least to protect purchasing power against inflation. So do you agree with that? And well, I know you do, but what would you say about what areas of the equity market that are good areas to be in an inflationary environment?
Well, Scott, as you alluded to, the risk of inflation from a consumer's perspective is that it erodes your purchasing power. So an excellent way to preserve purchasing power is to have an income stream generated from dividend-paying stocks and a strategy to invest in companies that consistently grow their dividends. And we're fortunate in Canada that our equity market is relatively dividend rich. On this chart, we're comparing the dividend growth of our CWB LFA dividend strategy with Canadian Consumer Price Index, or measure of inflation, annually since 2006. When markets correct and stock prices go down, dividend streams generally remain very consistent, certainly at the portfolio level. We can see here that our Canadian dividend strategy has consistently produced dividend growth that exceeded inflation in all years but one since 2006. In most years, the annual dividend growth is several times that of inflation. Can you imagine if your salary last year increased by 14%? That's the raise that our dividend income investors saw in 2021. Dividends won't prevent your portfolio's market value from falling during corrections, but the dividend streams are very consistent through the corrections, and the stock valuations eventually do recover.
Thanks, Gil. Very interesting chart. At this point, we were going to bring Saket Mundra into the conversation, but as Matt said, he's sick today. So I'm going to put Lily on the spot to answer this question. Lily's a co-head of U.S. equities with Saket, and she's based out of Edmonton. So Lily, U.S. equities have been the belle of the ball for a decade plus, outperforming almost any other asset class. But they've started to struggle a bit here. At least the index has started to struggle a bit here. Are there any areas in the U.S. market that look attractive, or is everything getting hit equally?
Hi, Scott, and hi, everyone. So yeah, when we think about the U.S. market, definitely has been a huge outperformer over the last 10 years, and this has changed basically from the chart you showed earlier. It's now in line with international markets. So when we think about inflation and interest rates, definitely been a big hit to the US market. And I just want to take that question and think about what we're doing to actually protect our portfolio against inflation. And really, it's not only against inflation, but any other external factor. So we do two things on the US side. First one is stock selection, and I'll talk about it in a moment. And the second one is diversification. And that's really important because we want to make sure we have an exposure to a variety of factors and drivers. And the main goal is really to avoid significantly overexposing ourselves to any particular area of the market. So let's say at the start of the year, if we were exposed to, let's say, slower interest rate increases, we would have been hurt. And so we generally try to avoid something like that. And now the second kind of a defense lies in stock selection. And so what we mean by stock selection is really try and invest in good businesses that could navigate different kind of environments, but also pay attention to what prices we're getting in, because we need to have that margin of safety. As we know, situation changes significantly over time, and we want to make sure we are protected. Now, let me give you an example with all that. So here on this chart, we're going to show you returns over the last 5 years for Netflix, the S&P 500, the US market, and Dollar General. Now, you probably recall 4 or 5 years ago, it was all about the FANG stocks, and Netflix, being one of them, was really a market darling. Everybody was really excited about them. Now, fast forward to today, and the return for Netflix is really underwhelming. So if you look at the last 5 years, the total return's 21%. That's definitely below the S&P 500 and the market. And in the case of Netflix, it wasn't really anything wrong with their product. I think their products actually probably improved over time. But really the problem was that the expectations built into the stock price were very high. Like if you look at the chart on Netflix, which is the red line, you see that at one point in time was up more than 350%. When the economy reopened, what happened is their subscribers declined, and all the gains that the stock has built up basically disappeared. Now, if we look at another business, that's Dollar General. I'm not sure if you know it, a pretty boring business, think Dollarama, but in the US. So over the last 5 years, as you can see from that chart, not only have they beaten up Netflix, which was probably one of the most talked about stocks over the last 5 years, but they've also handily outperformed the market. So I just wanted to give you Dollar General as an example because it was part of that stock selection defense I was talking about. It's a company that generally can do well in almost any environment. Let's say in good times, what happens is customers generally buy more stuff, so they benefit. But in bad times, what happens is they gain market share because clients usually trade down to save on cost. So in a nutshell, that's what we do to protect our portfolio in inflation. But as I said, this should work in any external shock environment.
Thanks, Lily. Put you on the spot there, and great job. Rick, so let's take off the fixed income hat, put on the equity hat, and talk about international equities. A lot of people thought this was going to be a really great year for international equities. It hasn't really turned out that way, at least yet. Maybe you could dive in a little bit on what's going on there and what you're seeing in the market.
For sure, thanks, Scott. Absolutely. You know, there was a lot of high expectations, particularly in Europe, of course, which is a big part of the international equity story. Coming into 2022, there was expectations because of fiscal policy and the European Recovery Fund, which is still in place, and also, you know, negative interest rates and just everything was sort of set up for Europe. But then when you have, you know, war in your backyard and you have supply chain issues and commodity price movements, obviously you get a lot of fear, you get a lot of panic, there's a lot of uncertainty, and in that, most people just sell. And what we're looking at here is a chart of European valuation, so MSCI Europe versus the US. So when the line is near the top of the chart, Europe is expensive and the US is cheap. When the line is at the bottom of the chart, it means Europe is cheap versus the US. You can see, no surprise where we are today. Europe is extremely cheap. This goes back to 2003, and clearly we've broken through below that. So it just shows how people and investors have just gotten out of Europe, and that's because valuations, frankly, in the short term, don't matter. People just read the headlines, there's knee-jerk reaction, there's fear, and people just sell. But for us, that gives us great opportunities, as Lily mentioned, as stock pickers, to do what we do, which is bottom-up fundamental investing and buying companies that, you know, if your time horizon is more than 6 months or a year, they're going to prove beneficial, and they're actually going to make money for the portfolio and help to outperform. We are finding a lot of companies that we own, and also new companies that we're seeing that are extremely attractive from a risk reward, and we've been selectively adding as the volatility sort of is in the market, and that's what we do. We don't profess to be able to control the volatility, but as bottom-up investors, we have to take advantage of that to create a robust portfolio for future returns and future ability to beat the benchmark.
Thanks, Rick. So let me just sum up this section and what we've heard from our panel. You know, inflation is a beast, no question about it. It's really hard to fully immunize your portfolio against it. But there are things you can do to minimize the impact. And a lot of those things are potentially already in your portfolio, whether it be floating rate bonds or whether it be things like owning Canadian equities, which have actually performed fairly decently through this environment. Canadian equities have underperformed US for quite a while, but boy, if you own them today, you're happy that you do. So the last topic that we are going to discuss, that we've received a lot of questions on, are we going into recession, and what about long-term investing? And we heard earlier Malcolm showed a GDP chart that showed what economists are thinking will be GDP growth next year and this year and next year, and it doesn't look like, at least the economists think, that there's going to be a recession on the horizon. Now, it's fair to ask, what if they're wrong? What if they're wrong and there is a recession? And I want to bring Malcolm back in here. People, we hear it from clients, our client PMs feed it back to us that people are sort of losing some confidence in bonds, or they're wary of bonds because they've had a pretty big drawdown this year. We heard from Rick earlier that yields have risen quite a bit in the bond market, which should potentially make them more attractive. But let's turn back to you, Malcolm. If you're worried about a recession, what do you think bonds? What would be the place for bonds in a portfolio? Is there a place?
Thank you, Scott. Let me take a small step backwards before I answer that. When we look over the long term, certainly you're going to find that equities outperform bonds, and by a comfortable margin. So the question always comes, why do you want to own bonds at all? And the reason, of course, is that equities will outperform, but with a lot of volatility, a lot of ups and downs over the course of the period. Bonds serve to smooth out those bumps. They tend to be either low correlation or negative correlation to equities. When stocks do well, bonds do poorly, and vice versa. In a recession, specifically in a recession, equities tend to do quite poorly. And that is actually an excellent time to own bonds. Not only do you get the stability that's there all the time, but typically you would expect to see central banks starting to cut their bank rates, and that's going to cause prices to increase. So oftentimes, and let's have a look at this chart, oftentimes during a recession, you'll see outsized returns from bonds. The gold bars on this chart show periods of recession, with the navy line showing the 12-month return for a 10-year bond, a 10-year Canada bond. And you can see that big spike following a lot of these recessions, a big uptick in the return that we see from bonds. So What I think the takeaway is from here is bonds provide a nice stability all the time, and during a recession, you do tend to get that outsized return from bonds. One last point just before I go. When we've seen the yields increase, which certainly we've seen this year, we're now saying, okay, well, now with new money, I can go into the market and buy at a higher coupon or a higher yield and look for better returns going forward.
So Malcolm, just to be clear on this slide, this is the actual return, just so people understand, make sure, I know I just want to emphasize it. This isn't those aren't increases in yields. Those are the actual returns that we're seeing on the bond market.
That's absolutely correct. That's the return on a 10-year bond. Yes.
Okay, thank you. So the other side of that coin is equity markets, right? We often hear people, and this is going to be a question for you, Lily. We often hear people comment about, you know, if you think there's a recession coming or you think the market's going to correct, why not just step aside, go to cash, come back in when things have calmed down, we're in a better position. You know, historically stocks have performed poorly in recessions, the opposite of bonds. So that idea of getting out sounds like an outstanding strategy. So what are your thoughts on that?
Yeah, Scott, I totally agree. It's really an outstanding strategy, but really the reason we can't, or we usually don't do that, is it's really hard to predict when a bear market or a correction comes to you. And let's say if we try and time that and get out of equities, but we're either too early or we're simply wrong, what ends up happening is we end up missing on quite a lot of returns. Just something to bear in mind that some of the best returns for the equity markets in particular are usually just in a period leading to a bear market. And I'll just give you an example here. So what you see on that chart is the compounded annual growth rate in the S&P 500, and that's over the last 10 years ending 2021. So the number is 12.7%, which is a really decent return for an annual return. Now, let's say we decided we want to time the market, but we were very unlucky and we missed the best 5 days in each year. Well, that number now drops, that 12.7% drops to a negative 0.7%. So definitely the moral of the story here is that, yeah, it might look tempting to go in and out of equities, but it could be dangerous if you don't do it the right way, which is extremely hard, if not impossible. So at the end of the day, what we're left with really is that the best bet is to stay invested throughout the economic cycle. The caveat, of course, here is that it can be and it will be painful at times, because what staying in the market means is occasionally we have to ride this pretty high volatility. And this year, 2022, is a pretty good example of that. We've had higher volatility, we have negative returns across asset classes, and really almost nowhere to hide, as most of my colleagues talked about. On top of it, we have this plethora of negative news articles coming to us daily or just hourly, I would say. So unpleasant ride, but if you want to be successful in the markets, you really need to stay put and not panic in times like that. Good news here is that if we forget about this for a moment and look at history and market returns, time's really on our side. And let me quickly show you why, which is what you see on this chart is the probability of negative returns over different time periods. Over 1 day, that probability is 46%, so almost a flip of a coin. But as the time horizon lengthens, things are really starting to look much better. So if your time horizon is, let's say, 10 years, you are only having 6% chance of negative returns over that time frame. So takeaway is that, yeah, if you're in for the long run, maybe you shouldn't worry so much about short-term volatility. But one thing to make sure is that you really invest your time horizon and also to your risk tolerance, because not everybody is the same and everybody takes volatility differently. And I strongly encourage you to talk to your client portfolio managers about that, because they're the best person to help you with that.
I was just going to say, I meant to mention before that why don't you wrap it up and give us our key takeaways from this. But I did want to make one comment on this slide. The time heals all wounds. The this ties back into what was being said in the asset class discussion. The last time that we saw a 10-year period with the S&P 500 having earned a negative return was the 2000s, that decade that started with the dot-com bubble. So it does seem scary that you may have a period of time where the benchmark is in negative territory, but that was actually a pretty good time for a lot of stock pickers who were able to beat that benchmark. So anyways, I just wanted to make that point. But why don't you take us through the key takeaways, Lily?
Yeah, sure. So yeah, now to wrap it up, I just wanted to leave you with our key takeaways, and really we have 4 for you. First one is, unfortunately, we should expect higher than usual volatility in the near term. We've already experienced a lot of that just since the beginning of the year, but especially over the last couple of weeks. And the reason for that is market hates uncertainty. And 2022, we've had plenty of that, starting with the war in Europe, then an increase in inflation and interest rate expectations. And now, most recently, we also had this China lockdown. So these uncertainty, lots of them in the market, for the volatility to really calm down, we really need to see some clarity on some of those issues. And there's a lot of expectation in the markets. We're going to start getting some resolutions of all of this in the second half, but we're about to see if that happens or not. Second key takeaway, it's very important, but people often forget about it, and that in market volatility really lies also an opportunity. And so when the market's going up, like when it was when we were going through right after COVID, lots of investors felt that regret not having put more money in the market at lower levels. Well, now we have it. We had this significant sell-off in both bonds and stocks. And yeah, maybe some of that's justified because we have this change in expectations for the economic side of things, but some assets, as Rick was mentioning, are starting to look quite attractive. Again, we don't know when we'll reach the bottom, but we know that really the best times to buy equities usually during those correction times or when it feels uncomfortable, which is definitely how today feels. A third key takeaway is something I just spoke on the previous slide, so won't spend that much time, but really it's around market timing, and market timing doesn't work. So really what's working is have a plan, stay invested in the market, but be prepared that once in a while you're going to have to ride that volatility. And one final point before we wrap it up, and that's something we spoke about to you in the fall, and that's expect the unexpected. Like, things are changing pretty quickly right now, and the reason for that is we're really living in these unprecedented times. We're just now emerging from this 2-year of a pandemic life, like a life we could never have imagined before. So many changes happened, and yeah, you would say we're not wearing masks anymore, but we're nowhere near back to normal or what life used to look like pre-pandemic. So things look, but they don't look great right now, but also wanted to point out is this could also change, right? And so what if inflation peaks today or tomorrow and then war in Europe ends? All of a sudden then we're gonna have this, the overall outlook gets much better, and so things can quickly change for the better too. Be prepared for any outcome and stay the course is what I want to leave you with.
Thank you, Lily. That was some great takeaways. You know, it's interesting, we end this presentation, the formal part of this presentation, with the same way we ended the one in November. You know, COVID's a crazy time and it's unprecedented and things change really, really quickly. So, you know, I think that's an important point to make. And you made another point I just want to highlight, you know, as we go through this presentation where the investment team is giving you their views on different markets and different asset classes. If you have any questions, if you are a client, you can obviously call up your client portfolio manager, make a meeting, discuss your objectives, your asset mix, those kind of things. If you're not a client, of course, we'd love to talk to you as well. But you know, that your client portfolio manager knows your personal situation and can have that discussion with you. So we do have some questions in the chat, and you know, just for fun, to keep you on the hot seat, Lily, I'm going to start with you. We sort of, you know, as we are putting this presentation together, we are thinking about what kind of questions we might have. And of course, one of the questions we thought we would have was around cryptocurrencies, because it's something we get a lot of inquiries about. So cryptocurrencies have been touted as being uncorrelated to other asset classes. What are your thoughts on using cryptocurrencies for portfolio diversification? And just before I turn it over to you, Lily, I think Bitcoin's down to 30,000 or maybe even a little bit less. So, you know, it has come off quite a bit.
Yeah, it's true. Like cryptocurrencies have been extremely volatile this year. And let me just first answer your first question, which is how about why don't we invest in cryptocurrencies as a way to diversify the portfolio because of this lack of correlation? Well, my answer is that, yeah, we think that the technology can be quite useful, but for now, there are two things that are preventing us from investing in that market. The first one, we're still in early innings and it's unclear how that market's going to be regulated, and it is really important to get clarity on that. But second is we also don't know how to value them. And so without having some clarity on those two things, if we're going to invest in those assets, it's going to look more of a out of speculation rather than because we believe there's value in owning all that. When it comes to correlation, it seems like they're pretty correlated with equities these days because I think crypto's down more than 30% year to date, and it's really have been moving along with equities. And so definitely I would not, at least at this point in time, see them as a good diversifier.
Thanks, Lily. There's another question in here, and I don't know if you would like to address this, or Gil, I don't know if you would like to address it. Gold has typically been seen as a hedge against inflation. Why has gold not performed better in 2022 with inflation numbers above 8%?
Yeah. Well, Scott, gold hasn't really performed vis-a-vis inflation the way it has historically for a long time now, actually, probably 15 years or more. What gold has done, or when it has performed, is really in the face of large risk and large uncertainty. And certainly we saw that around the beginning of the pandemic, when there was a lot of both of those things going on. But since then, gold has retraced somewhat from above the 2000 level, but it's holding in fairly consistently around 1900. But it's an accurate observation and not particularly surprising that gold is not really seen as the inflation hedge anymore. The US dollar, I think, perhaps is being seen as that safe asset versus inflation. But gold is just no longer being used that way.
Hey,
Thanks,
Scott,
Gil.
can I jump in for a second?
Absolutely.
Yeah, so I think just tying it all together, the problem is that we've seen real yields, which have been tremendously negative, move in the US, for example, move towards zero and positive. So when real yields are negative, the opportunity cost of holding gold, of course, which doesn't pay a dividend, or crypto, of course, which doesn't pay you anything. So the opportunity cost of holding those type of assets is really negative because U.S. Treasuries are yielding in real terms, yielding a negative yield. Now that yield is zero and turning positive, it's very difficult for these type of assets to outperform. Similarly, as we've seen, when real yields are going from positive or negative to positive, the U.S. dollar has strengthened a fair bit, and of course that because a lot of crypto and gold is correlated highly to the U.S. dollar, you get underperformance. So I think all of those things, when you look at why these two assets classes have underperformed, it's really a story of real yields and where real yields are going to go. And it's not a positive backdrop by any means.
Thanks, Rick. Yeah, that's good insight. Thanks, Gil, as well. So, Rick, we're going to stick with you. And we're going to have a little conversation about China. So what are your thoughts? I'm assuming you have some thoughts on China. Of course, I know you do.
I should. I better.
What are your thoughts on China given their response? Lack of any lack of, I guess, response to the Russian invasion of Ukraine. Is China reaching non-investable territory from an ESG perspective?
Well, we don't think so. I mean, I think there's a lot of, I don't propose any political sort of understanding and how, these back channels work. I don't know. What we understand is that overtly they are not helping Russia. And so I don't think China wants to have more sanctions put on them in an environment where really everything China has done has been self-inflicted. So last year, China was raising interest rates and really being tight with fiscal policy, and that's really impacted the market. And now this year, China has been cutting interest rates and stimulating their economy when the rest of the world, as we know, has been tightening, led by the Federal Reserve. So from that standpoint, I think China is not uninvestable, and I don't think the second largest economy in the world should be uninvestable. There should be opportunities there, and we're finding them directly through Hong Kong and finding opportunities there, and also indirectly through companies in Europe, for example, that are leveraged to Chinese domestic demand and discretionary income in China, which is going higher. So I think the answer is no. We don't think it's uninvestable, and we're finding tremendous opportunities there that I think will add value as we move forward.
Great, thanks, Rick. I wanted to ask, and maybe this one, Malcolm, I'll bring you into this one. You have a history as a client portfolio manager, doing double duty, working with clients as well as working on the fixed income side. So we have a question in here. My investment horizon is 20 years plus. How do your recommendations change if I intend to hold the portfolio for this long?
Mm-hmm. Mm-hmm. I'm presuming you mean as far as, do I still want to own some equities and some bonds? But yes, I think as long as you have that longer term horizon, you want to have some of each asset class. There are going to be periods when equities will do well, going to be periods when bonds will do well. And certainly you can tilt your portfolio one side or the other, say, okay, this is a better time for equities, I'm going to tilt a little bit more that way. It's a bad time for equities, I'm going to tilt more towards the fixed income. But you still always have that diversification there. The equities are providing the growth, the bonds are providing the stability. I think that where it really changes your opinion is when you come into very short periods of time. You say, I've got a 1 year time horizon, I've got a 2 year time horizon. At that point, you say, I need to have this money in 2 years' time. That's a much more of a bond approach than an equity approach. So I don't think it's the length of time. It's when you're looking at very short periods of time that you would really want to change your portfolio significantly.
Yeah, great answer. And I think the other point we have to make is that everybody's situation is different. So that's a generic answer for a 20-year time period. But it'd be great to have a conversation with a professional client, one of our client PMs, to discuss your specific situation. So why don't we now go to, I'm just scrolling through the questions that are in here. So given the drop in bond prices combined with the increase in yield, how does this increase in yield actually combat inflation and purchasing power when inflation is currently floating around 6%? Rick, do you want to take that?
Sure. Well, it's twofold. I think, first of all, if you believe that central banks are going to fight inflation and eventually will win, which is a pretty good assumption because, what we saw in the 80s is, central banks, if you think about Volcker, can raise interest rates to 20% and absolutely decimate inflation. Of course, you decimate the economy as well. And this is the tug of war that we're seeing now in in equities and fixed income, how far will central banks go to quell inflation? So if you believe that central banks, that premise that central banks will eventually have inflation roll over and move towards the 2% target, then having that 5% yield or 6% yield as inflation is rolling over is great risk reward in our opinion. So and as Gil and you mentioned it too, Scott, like from here, in order for inflation to go up from here, it's not good enough that gasoline stays at these levels or oil stays at these levels. We actually have to see oil and gasoline move higher from here. If it doesn't, stays flat or whatever it does, it means that inflation is gonna stay flat or even roll over because of the base, because of the base effect. So I think there's two things at play, but generally when you have in this environment, there are bonds and there are instruments that have plenty of inflation compensation built into them that look very attractive. If you believe the assumption that central banks are serious about fighting inflation, which I think is a good probability.
Yeah, you mentioned something as we were preparing for this presentation, Rick. You gave the often the great market forecaster Wayne Gretzky had said, go to where the puck is, go to where the puck is going, not to where it is. And I think that's the point that you're making is, where's inflation going? Where it is now is not as important as where it's going. Would you agree with that?
No, I definitely would. And I think that's, inflation is by nature backward looking. I mean, even inflation that we saw this morning is just about what happened in the prior month and in the prior year. So, we have to think about, as you said, where is the puck going to be? And that's there's risk reward and probabilities associated with that. But if you can if you can be compensated for that, and not to get into too much specifics, but we're buying 3-year bonds that are yielding close to 5%, and we're buying some callable bonds that we think are almost sure to be called in 2 years that are yielding over 6. Like the probabilities of us being wrong on that is very low. Even if inflation doesn't do exactly what it's supposed to do, but at the end of the day, if you're getting that type of compensation in terms of your yield, it's a pretty good bet that you're going to outpace inflation in your portfolio, and your purchasing power will definitely benefit from that.
Great. So I'm going to try to squeeze one more in here, and Gil, I'm going to put you on the spot. Question in here about over diversification, and as Warren Buffett says, diversification is for those who don't know what they are doing. What do you think about diversification? Like, the index is the most diversified thing you could buy out there. Like, as you're building portfolios, maybe I'll let you speak for the team. Are you over diversifying your portfolios? What do you how do you think about that?
Yeah, I think the term that we've adopted for that is diversification, Scott. So diversification is very important, but beyond something on the order of 40 to 50 names, then you really start to reduce the return generating capability of the portfolio. So your good ideas in terms of the stock picking that you're doing start to get watered down. So you want the diversification to allow the portfolio to be as, let's say, low volatility, as much low volatility as possible in the context of the market. But at the same time, you do not want to avoid all types of risk, because risk is what ultimately allows you to generate returns and allows you to generate excess returns. So risk is important. We have to take it. We don't want to diversify all of it away. And by stock picking and by diversifying to an extent where we can get rid of most of the volatility, we can reach that balance of risk reward that we're looking for in the portfolios.
That's great. Thanks, Gil. Diversification is a term I have heard many times. Thanks a lot.
First, Scott, if I could just add one more thing to that, I think
Sure.
The other thing that's important is active weight. So, I think if you look at a portfolio, for example, and you hold 5% of a stock, Microsoft or whatever it is, but the benchmark holds 7%. Well, you're not really at that point. If you are, the risk reward is not on your side. If you believe that the particular stock you're holding is gonna outperform, the market. So, for the international, there's over 5,000 stocks that are in the index, and the active weight, or how much more we have in there versus the bench, is also a way that we control the risk, and a way that we monitor diversification and capital allocation of how we're going to try and beat the benchmark in the best risk reward possible.
Yeah, it definitely depends on which markets you're talking about, and the market that you invest in on the international side is a very deep market with lots of different geographies. So it's a great point. We're a minute over the time allotted, so I'm just going to close the presentation here. I just want to thank everybody for joining us here today. Thank everybody for attending, and thank the presenters for the panel for their thoughts. And I want to give a special shout out to Ivana Babic, who has helped us with these slides and has really put in a lot of time and effort into this. So it's very appreciated on that side. So Matt had said, we'll be together again soon in person presentations. We already have a few that are lined up over the next few months and whatnot. I know I'm going to be in Lethbridge in October, and there'll be other things that'll happen through the time period. So we're really excited to not be behind our computer screens going forward, and we hope to see a lot of you in person over the next little while. So thanks again for attending, and we will see you next time, hopefully in person.